Alright guys, so today's the day we're talking about stocks and shares ISAs, and if we were to talk about that group of 5 friends again, the stocks and shares ISA is the one that goes a little wild, they get a little bit crazy, but you know that in 40 years time they're still going to be in your corner. There's only one type of stocks and share ISA, but you've got 3 different types of platforms to choose from. The first one is the do-it-yourself assets platform. The second is the do-it-yourself funds platform. And the third is the Robo Investor. The first platform we're going to look at is DIY single asset platforms. And a DIY single asset platform will allow you to buy and sell individual stocks and shares of a company like Facebook or Alphabet, who own Google and YouTube. Single asset investing is the most volatile form of investing because a company's shares could go up and down in value by over 20% in a day. DIY single asset investing requires a deep understanding of the companies that you're investing in, but also of the worldwide economy. With a DIY single asset platform, the most important thing to look out for is the fees. The different types of fees you can face are annual fees, platform fees, or an individual fee per buy or sell of a stock. You also need to keep an eye out, depending on your situation, as to whether the fees are a flat rate or based on a percentage. With a small amount of invested capital, percentages are going to work better for you than a flat rate. It's a bit complicated, but the formula for that is A, which is your total capital or the buy or sell value in pennies, divided by 100, times by B, which is the percentage fee. So 10% fee would be times by 10, a 1.25% fee would be times by 1.25, and that equals C. You then need to see whether C is greater or lower than D, which is a fixed rate fee. The next type of platform we're going to talk about is a DIY fund platform. A fund is basically a collection of different companies' stocks and shares. And a fund can either be actively managed, which means that some smart ass picks what stocks and shares go into it regularly, or it could be a passive fund, which isn't managed by an individual, but it tends to track or follow a stock index. Actively managed funds are going to be more expensive because you've got to pay for the stock fund manager's 3rd or 4th holiday home, whereas a passive fund has no one person managing it, so the fees and charges are going to be much less. Fund investing is still volatile, but it's far less volatile than single asset investing, because on a good or a bad day, a fund could go up or down by 5%, a maximum of 10% in a day. It is also worth noting that if stocks within a fund are not performing well, they're cut from the group, and a new one is put in to replace it that is performing well. So typically speaking, a fund is only ever going to consistently go up in value over the long term, whereas an individual asset, if that underperforms, it could go down and stay down, or it could go bankrupt and you lose all of your initial money invested. This makes funds more secure as a long-term investment than an individual asset, but you're potentially going to get less growth and less return. If you're looking to open up a DIY fund platform, here's the sort of things you need to keep an eye out for. Is it actively managed or is it a passive fund? What are the fees and charges associated with the platform? If it's actively managed, what stocks and companies make up the fund? And if it's a passive fund, what index is it tracking? Again, similarly to individual asset funds, you need to know, based on your circumstances, whether it's better to have percentage fees or flat rate fees. So work out which fees are best for you. The third type of investment platform is the Robo Investor. A Robo Investor, also known as a set it and forget it platform, will take a pre-agreed amount of money from your account each month, and it will do all of your investments for you. What it does is it uses a questionnaire when you open the account to find out your attitude towards investing, your risk tolerance, and your goal timeline or your goal horizon. It then makes investments based on the amount of time that you want to be investing for and your attitude towards risk. You don't need any knowledge to get started, and you can decide how much you feel comfortable investing. Robo-investors use funds typically because they're cheaper to purchase and they're less volatile. But a robo-investor will be more expensive than a DIY funds account because they're doing the investing for you. If a robo-advisor offers a no fee or reduced fee promotion, you need to have a look past that promotion to see what the fees and charges are going to be in the long term. It's possible to transfer a stocks and shares ISA from one company to another, But in order to do that, you need to sell your stocks or funds in that platform in order to get cash to transfer the cash across. And what you don't want to do is you do not want to sell stocks and shares when they are undervalued or below the value that you bought them for, because then you're locking in a loss. Investing is for the long run, so don't put money into investments that you think you're going to need to withdraw soon. For example, don't put your emergency fund into an investment account, and don't put your short-term savings into investment accounts, anything from 1 to 5 years. If you're looking to open up a Robo Investment account, this is what you need to keep an eye on. You need to keep an eye on your fees and charges. And again, is it better to have them as a flat rate or as a percentage-based fee or charge? You also want to have a look at the minimum account balance. Some investment accounts require you to pay in a monthly direct debit of £100 or £50 a month. Some are just happy that you have £1 in there and you keep it open. I remember as a kid when I used to play on PlayStation, I used to love when I could find a new cheat code for my favourite games, whether it was GTA or Resident Evil. You'd find those cheat codes for unlimited life or unlimited money. The game took on a whole other level. Well, this is the cheat code to investing. It's called dollar cost averaging. As I mentioned before, investing is incredibly volatile. Stocks and funds go up and down in value every second of every day. But this cheat code is going to help you to take the stress out of trying to time the market or trying to beat the market. Dollar cost averaging isn't just an investing strategy that reduces volatility, it actually uses volatility in your advantage. So let's take a look at this example here. It's a 5-year window of the market with 0% change from the start to end, but lots of volatility in between. On day one, if you invested £6,000, it would be worth £6,000 after those 5 years. So the dollar to cost price would be 1 to 1. If you were to dollar cost average and invest £100 a month, you would have bought over and under the end value, but the dollar to cost price would have been 1 to 1.1. So £6,000 times 1.1 would have given you £6,600 and a £600 profit on 0% growth. This second example shows how in a down market you can reduce your loss. So on day one, if you invested 6% in the market, it would be worth £4,800 after the 5 years because it's lost 20% on a steady decline. If you were to have dollar cost average, again £100 a month, you would have been averaging out the cost through the decline. So your dollar cost ratio would have been 1 to 0.90, which would have meant you had £5,400 at the end of the 5 years, which is a loss of £600 as opposed to a loss of £1,200. Where dollar cost averaging holds you back is through steady growth. So this example shows 20% steady growth over 5 years. On day one, if you invest £6,000, you would have had £7,200 at the end, which would have been a dollar to price ratio of 1 to 1.2. The dollar cost average would have averaged out the cost on the upside, meaning your dollar to cost price would have been 1 to 1.1, which would have given you a profit of £600 or £6,600. These are just hypothetical situations and they're not based on actual stock market results, but they're just designed to show you how dollar cost averaging would work in a flat market, a growing market, and a declining stock market. So that brings the Stocks and Shares ISA episode to a close. Hopefully you found this useful and interesting. Of course, in investments there is downside. You could potentially lose all of your invested capital. That's more likely to happen with individual asset investing. If you're investing in funds, and especially funds that are backed on an index in a stock market, it's most likely you're going to see slow, consistent growth with a few down years. You're going to have years where you lose 5 or 10%, but you'll also have a more consistent growth period over the long term. If you're looking at 20 to 30 years of investing in funds and indexes, it's very, very, very unlikely that you're going to see a massive loss, if any loss at all. So stay the course, don't invest for the short term, invest for your retirement now and live on a tax-free wealth later on. And remember, stay cash flow strong and turn your wages into wealth. I'll see you soon guys, look after yourself, bye bye!
Bing!